Hey, hi everyone. Welcome to another video in our positional option selling adjustments series. So today we are going to go through short iron fly positional trading strategy adjustments in Indian index markets, and we will go through various scenarios and examples from Nifty, Sensex, and Bank Nifty. Okay. So what's a short iron fly? Iron fly is a hedged position of short straddle. In short straddle, you will sell an ATM call and a put. In iron fly, but it has and if infinite risk basically, and it's not a hedged position and risk is not defined there. Unlimited risk is there. But here in short iron fly, what you do is you hedge it with buying one OTM call as well as one OTM put. Uh, from same distance from the ATM. So that will make it a iron short iron butterfly or short iron fly they call it. Okay, so short iron fly they call it, and it's basically short straddle hedged with wings, and where the risk is defined. It's a range bound strategy. This is not a directional strategy. This is again a range bound strategy, and we are talking about positional strategies. Okay, so when Nifty is at 20,000, if you sell a 20,000 C and sell a 20,000 P, you take hedges of by buying a 20,200 C and buying a 9,800 P, then it becomes a short iron fly. Your view is you are expecting the market to stay near the strike or within your range until expiry. The theta decay will be high, so high theta decay will be there because you shorted both the ATM call and the put, and if the price doesn't move, then you can gain from the high theta decay potential. Risk is large directional moves can happen, and that can cause losses, but the risk is capped by the wings. Losses are capped by the wings. So adjustments, market stays within your near ATM strike. That's an ideal case. So time decay erodes both the ATM options fastest, and that will give you the profit quickly. So you don't need to do anything. You just let theta work on your side. So do nothing. Book the profits once it reaches 70% of the potential profit before expiry. If you want to, if you still have that position that it's going to be range mode, then you can create a new straddle at a new ATM strike. So that's the thing. So when market stays near the ATMs, you just do nothing, let theta work, and you book the profits. The next scenario is price moves up towards your call wing. So your call wing is challenged here because prices become bullish. You have sold a call, so that will get challenged. So that call side starts losing money, and uh, okay. So what you could do is you can roll up the put side. So put side, yeah, you can. What you could do is you can move this short put, whatever you have taken, closer to ATM. Okay, so because the market has moved from that ATM to a different point, then what you do is you take the put position and put it at the ATM, so that you could do to offset the losses that are happening on the call side. Or what you could do is you can entirely close that short straddle, and you put a new short straddle at the new higher ATM. Okay, uh, that's what you could do again. And if your view is still range bound, right, that's when you do this. When your view is range bound, you close this entire short iron fly, and then you put a new iron fly at a new ATM, higher ATM, where the market is there right now. Or you roll up a put side because uh, you want to offset the losses by collecting uh, the premiums. Okay, or what you could do is you could convert it into broken wing butterfly. So move upper wing farther away to reduce call side losses. So that you could do. You can convert it this iron fly into a broken wing butterfly. So you can move the upper wing farther away to reduce call side loss. Okay. So example is, you sold a 45,000 CEP and you bought a 45,300 CE and 44,700 PE. Bank Nifty rises to 45,150. Okay, so it has broken your call leg here. Then you roll your short put, which is 45,000 put. You roll it to 45,100 because it has moved, right. So you roll that to 45,100. Or what you could do is you just close this entire position, build a new position like 45,100 CEP and 45 400 CE, 44 uh, 800 P. So that's what you could do also. Okay, so that you could do. or you could convert it into broken wing butterfly also. Okay. So third thing is, yeah, same thing again. If market challenges you on the put wing, so market moves down, it becomes bearish and challenges your put wing. Then put side loss increases, call side will gain. So what you do is you move that call side closer to the ATM, and for extra premium collection and for loss reduction, or you entirely remove that existing thing and shift the entire structure to the new ATM if your bias uh, turns bearish, or you could convert that into a broken wing butterfly again. Whatever lower wing is there, you move it farther away to reduce put side loss. That's what you could do. Okay. So example again is same. So the example is you shorted at 67,000 CEP and you bought 67,300 CE and 66,700 PA. Market fell to 66,850. Okay, and it broke your 67,000 PE leg. So you roll this short, right? So 67,000 CE, you'll move it to 66,900. That's what you'll do. So market strongly breaks your call wing, then call spread is fully becomes ITM and put spread also becomes worthless. Then you close that call side immediately to avoid a max loss, and you roll side. You can roll up the put side to ATM to cushion the losses, or you could turn your view from range bound to bullish, and you could put a bull call spread for the next expiry. Similarly, for when market sharply breaks your put wing, your put spread fully becomes ITM and call spread becomes worthless. You close immediately the put sides to so that losses are less losses are there, and you roll the call side to the ATM for more credit. And if your view is again changed from range bound to bearish, then you can put a bear put spread for the next expiry. So practical examples are Nifty 22,000 CE and PE you have sold, and you bought 2200 CE and bought a 19800 PE. Net credit is 120. The market is between 19950 and 20,050. You hold and book the profits. If market has went to 120, okay, then roll the short put to 20,000. Okay, so from 2200 you 20,000 P you roll that short put to 20,000. Yeah. And similarly, when market went to 1980, you roll the short call down to 20,000. Okay, if it breaks the 2200, so 2200 if it breaks, then you close the call and you roll the puts up basically. And if it breaks 19800, this one you close the put and you can roll the calls down. So similar examples are there for Bank Nifty as well as Sensex. What you're doing is, if it's within the range, your view is correct, you hold it, book the profits. And if one of the leg is challenged completely, then you can turn your view to either if bullish market has become bullish instead of range bound, you put a bull call spread, and if it become bearish, you put a bear call spread. And if it has slightly challenged your wing, you could move that wing up, or you could move the other side to near to the ATM, so that you can recover the losses. So that's the adjustments, guys, for short iron fly. And risk and timing notes are best entries when high IV environment is there before a period of expected low volatility should be there. And uh, avoid holding too close to expiry if price is near a wing strike, because gamma blast could happen. But again, here even if gamma blast happens, your risk is defined here. What we are trying to do is, we are trying to if market is going to be range bound and less volatile, then you're trying to gain from theta decay here. Always have a pre-decided exit level rather than the strategy loss. You should also have your own uh, decided exit level, so that you can avoid the maximum loss. And rolling closer to ATM increases gamma risk. So use only if confident in range holds. Okay. So what do we mean by pre-decided exit level? Is suppose the strategy loss maximum loss is suppose 10% of the capital. This is an example. But if you had in mind, if it reaches 5% of my capital, I'll exit. Then you exit at that. That's what a pre-decided exit level means. Okay, this needs to be only deployed when your view is range bound. You analyze the higher time frame charts as well as the macro environment, and then only you take such decisions. Okay. So that's it for today, guys. So that's the short iron fly adjustments. Thanks everyone for joining the call. Have a nice day. Bye.